What are the factors affecting the stock market? The factors which affect the stock market include economic factors like GDP growth and inflation, corporate performance, government policies and political stability, investor sentiment and psychology, and global events such as international relations and natural disasters. Other key drivers are supply and demand for specific stocks and the overall market, and the interest rates, which influence borrowing cost and investment decisions. Now, the economic factors. 1. GDP growth. A strong GDP indicates economic health and often leads to a bullish market, while a concentration can signal a downturn. Next, the inflation. High inflation can decrease consumer purchasing power and corporate earnings, negatively impacting the market. Third one, the interest rates. Central bank interest rate changes significantly affect stock prices by influencing borrowing costs for companies and making other investment more or less attractive. And the last one is unemployment rates. High unemployment can reduce consumer spending, which affects corporate profits and can cause stock prices to fall. Now, what are the corporate and market specific factors? First one, the corporate earnings. A company's profitability is a primary driver of its stock price. Strong earnings reports can boost a stock, while poor performance can lead to a sell off. Second one, supply and demand. The fundamental economic principle of supply and demand dictates a stock prices. When demand exceeds supply, the prices goes up. When supply exceeds demand, the prices falls. Now, the dividend declarations. A company's decision to pay dividends can influence its stock price. Political and policy factors. Government policies. Changes in tax laws, regulations, and economic reforms can directly impact market confidence and performance. And the political stability. Uncertainty caused by a political instability, elections, or geopolitical events can lead to market volatility. The last, global and sentiment factors. First, the global events. International conflicts, pandemics, or trade agreements can have a significant impact on the domestic and global stock markets. Second one, investor sentiment. Market psychology driven by news, rumors, and emotions can cause prices to fluctuate even when fundamentals haven't changed. The last but the least, the exchange rates. Fluctuations in currency exchange rates can affect the profits of companies with international operations and influence foreign investment. What makes the stock market go down? If more people want to buy a stock, that means the demand, than sell it, supply, then the price moves up. Conversely, if more people wanted to sell a stock than buy it, there would be greater supply than demand, and the price would fall. Understanding supply and demand is easy.